Today, I want to talk about a market update with you. We're going to look at SPY. We're going to look at TLT. We're going to look at USO and GLD. That's the commodities for oil and gold. I want to take a quick look at Bitcoin and Ethereum because we did get some pullbacks last week that I thought were very important when you look at them. And also, I want to talk about expensive options today and the difference between statistical and implied volatility. So that's what I want to cover with you here today. Let's go ahead and talk about SPY. So SPY, what I've done is I've taken the Fibonacci levels from back in November to where we were about a month ago, and we've got that trend up. We've since then had a pullback. And so since April, we got a pullback that took us from about a little over 520, about 523, down to around the 490 level. And we bounced around 490 for a bit, but last week we jumped. And a lot of this was off of the labor report, which came in a little softer than expected. So remember, last week everyone thought the rate hike, or excuse me, the rate cut was off the table, and now it seems to be back on for September. And we'll see where this ends up eventually going. But it looks like the stock market is trying to run up and jump to new all-time highs based on what I told you last week. We were talking about sell in May or stay in May. And it was based on all the research that we're doing that stay in May looks like the right way to go. Then we should see new all-time highs sometime in May. Now, we've got earnings that are still coming out, and we're going to talk about those here a little bit with the expensive options. But, you know, what used to be a drag, the end of earnings season used to be, for years, used to be a drag because it was all bricks and mortar toward the end of the year. These are actually now kind of helping to bolster earnings than they have for the last couple of quarters. We'll see where those end up going, but things look good, at least for last Friday and today for the stock market. Take a look at bonds. There's a lot of reason why things look good for the stock market is we came outside of the red zone here. And the red zone, I'm talking about the lows that happened late last year at 82.77. This is for TLT. The highs at 152. So we went through the first quadrant of the through the highs into this yellow area. This is I called this the Goldilocks era last week area. And so 89.55 to 93.74. Well, guess what happened last week? Last week we bounced off of these lows that were in around the high 80s, and coming into today, here we are above 89.55. We're back in the Goldilocks era. And that is part of the reason why the stock market's bouncing is because interest rates dropped a little bit on this chart, and that is easing some tensions in the stock market. Oil has had a pullback. And so you can see what's happened in the last week and a half. We've gone from above 80 on USO down into the mid 70s. We're bouncing around 75, 76 right now. Is this a pullback buy? I believe it is. I believe it is. I believe what we're seeing is we're seeing some pullbacks because oil had such a good run. When you go back to February and you see this thing going from the high 60s to the mid 80s, there is a chance of pullback, and that's what's happening. We pull back into the 38% retracement level from low to high. And so that's an important area right there. I think that whole area from the low to mid 70s could be a very good buying area, but I only want to be long maybe until July 4th, and then I want to look at maybe getting out of that. But that's based on multi-month seasonality. Gold also had a bounce that came in today, so it had an interesting inverted hammer on Friday after the report. It has gotten some news today, although I said this last week, I'm going to say it again. I believe that as we enter into the end of May and we go into the month of June, that's typically bearish for gold when we look at seasonality. So if we're going to see a bounce to new highs, I believe it's going to have to happen this month. It's going to have to happen here in the next couple of weeks. Now let's turn our attention to Bitcoin and Ethereum, where we've got a 50% bounce off of Bitcoin last week. All right, so last week coming into Friday's jobs report, Bitcoin came all the way down into below 57, into the 56s, and that hit a 50% retracement level at 56,320. We've bounced off of that. We had higher highs this morning, but we have had a little bit of a pullback. And, this could be a breathing area. It could be a breathing area for Bitcoin because, we have had that move to the downside. We had a quick move up. We've gone from 56 to 65, almost 66 earlier today. We've had about a 10,000 point bounce just in the last few days. So we might be just getting a little bit of a breather here, but there's also concern that we're seeing some lower lows. Could we drop down into the low 50s? It's possible. But again, Bitcoin is going to trade more with the stock market. The stock market's moving higher. Bitcoin as an asset should move higher as well. Ethereum's kind of the same thing, but Ethereum's running into that lower area of support, the triple bottom that actually started back in April. And we actually had 3 dates in April where we exceeded that below that 3,000 point. Right, we did it again last week, and then we jumped up from 3,000 to almost 3,300 before getting a pullback. We're below 3,100 again as of right now. This area here seems to be a really good area of support, and it better be, because if we get below and close below this level, and this level we're talking about is around we're around the 2,900 level. We get below 2,900, we could be kind of pulling back. And really, until we start hearing some more substance on Ethereum and the potential Ethereum ETF, I'm going to say between Bitcoin and Ethereum, this one is going to be the weaker of the two. Now, let's talk about let's talk about volatility. And I want to talk about the differences between statistical and implied volatility. Now, statistical volatility, when you hear the term SV or statistical volatility, I want you to think of the stock market. And statistical volatility is based on the past movement of stock prices. So what we do is we get a 20-day historical or a 90-day historical on stock prices, and based on those range movements, we get an idea whether volatility is high or low. And you may know that with indicators. So if you're putting indicators out there like ATR, that's average true range, or Bollinger Bands, those are just 2. There's several out there that are based on range measurement of the stock. Then you can get an idea of what statistical volatility looks like. Implied volatility, now you need options to get that. And implied volatility is what option traders believe future movement is going to look like. And that's built into option prices. It actually is built into the time value portion of option prices. And that's where we get the term implied volatility. Now let's look at Apple stock so I can give you a comparison. This is Apple's statistical volatility. This is a 20-day statistical movement. And what you see is when you see Apple's prices kind of consolidating like you do right here, you can see that statistical volatility dropping. When statistical jumps, it's when you get a jump in the stock price. So notice here on the chart back at the beginning of the year where Apple jumped from about 185 to around 195 and then back down to around 175. Look at that historical or that statistical volatility just going up, up, up. Then it dropped because we started to consolidate in price. The daily ranges got lower and lower. From here, you see these drops that happen day after day. Well, that was a spike up. And look what's happened recently after Apple announced its earnings. And we went from around 170 up to 185 and then dropped down a little bit today. You can see here, statistical from last week to this week jumped from around 22 to 32. That's because the price jumped so wildly from last week to this week. So that is statistical volatility based on past movement of stock. Here's the same chart of Apple, but with 7 to 30-day implied volatility. Now this red line, what we do is we look at the near money options and we run equations to get what option traders believe is going to happen to the stock price in the future. Now, the difference between the two, because if I were to go back, you'll see high. Well, I've got the high kind of hidden here, but you've got a high in this area that happened right around earnings. You have a high that happened after earnings here. When you look at implied volatility, those highs typically come before earnings. So you see that run up because what's happening is option traders believe there's going to be a big move in Apple just after the earnings report. And that's what happened, especially happened at this time. You see just last week, that high that ran up, the implied volatility got up as high as 40. Once the earnings were announced, that volatility dropped down to 20. And that's because the move happened. So implied volatility helps predict that range move. What's expensive right now are these. These are the top 10 most expensive stocks. What we do is we take their high implied volatility over the last year because we keep all this data. We take its low implied volatility over the last year, and we take what is it doing right now. So if you look at SG, very high. It's on its 1-year high. You look at a commie, all right, 47.87 was the high, 17.33 was the low, 47.87 is right now. Right now is the 1-year high, all right? Planet Fitness. Planet Fitness is very hot in implied volatility as it's sitting on its 1-year high. QDEL also sitting on its 1-year high. Race, that is Ferrari. Ferrari's 1-year high, 33.88. 1-year low, 17.65. Right now, 33.88. Options are as expensive now as they've been all year. Same now, Lyft had a high of 125, a low of 52, and right now they're at 97. So they're not on their 1-year high, but they are in the most expensive right now. Not there, but pretty close. Robinhood, same thing. Toasty, same thing. MTCH is off a little bit as well, and we round out the top 10 with EMR, high of 32.88, low of 15.69, and last of 32.66. So what does this tell you about these top 10 stocks? I can tell you right now, these are ones I would not want to buy options on. If I'm bullish, I don't want to buy call options. If I'm bearish, I don't want to buy put options. They're just too expensive. Better to sell premium in these 10 stocks.